All right. Well, I teased this a little earlier. Let's get into it. Bond markets. Well, they did sell off heavily last week, sending those bond yields soaring. What caused that plunge, and where should investors be looking for safety? Frank Donnelly now joining us from MA Financial. Frank, good to see you.
Andrew, good to be back.
Yeah, I mean, it's been a fascinating ride for particularly some of those in fixed interest at the moment. And of course, well, I was just mentioning this in an earlier interview as far as that key data point this week with US CPI out. And once again, we're going to see those yields move, aren't we?
Look, I think that's right. Volatility in fixed income markets, but particularly public fixed income markets, so traditional bonds, continues to be very, very high. I mean, we're seeing volatility in global bond markets at the highest levels really since around the early COVID period, and that was obviously, quite substantial. What happened last week was that you saw some really mixed data out there in respect of the US labour market, a slowdown in job creation, which is a good thing actually. It shows perhaps that the Fed's activities are working, but then you saw your wage growth in the US be stronger than expected, and it really sent bond investors into a little bit of a tailspin. Pricing yields up quite significantly, and you can see on the screen the level of volatility that we're seeing, and particularly those volatility spikes that keep happening this year. So look, that's continuing to occur, and what's really happening, most importantly, rather than the specifics of why there was volatility last week, is that investors keep betting that the Fed's job is close to being done, and they're doing the same thing here with the RBA. Continually, you're seeing fixed interest investors bet that we're probably close to a cash rate peak, and maybe we'll see things stabilize, and then you see data that surprises them. So I think that's actually the real lesson there, which is be really careful about betting that the job is done.
Well, I guess it's wishful thinking, isn't it, on many of the investors' parts. But also, I guess, you only have to look at what happened in China yesterday with that CPI and PPI numbers to perhaps realise, well, certainly, perhaps, globally, we are near the end of that tightening cycle.
Well, it's probably quite market specific. I mean, that's right. You see what happened in China. I mean, where there's talk there of deflation really coming in, and potentially a need to stimulate. So I think you're going to continue to see quite market specific nuances globally. And what that really means is you have to stick to fundamentals. The more you try and become take a macro bet, whether it's betting that it's time to take fixed rate duration, which I think is an extremely risky bet, despite the fact that there are a lot of people promoting that particular trade. I think it's time to actually stick to bottom-up fundamentals, whether you're in credit like me or whether you're in any other asset class.
All right, so as we keep hearing, particularly from the central bankers, that rates are likely to stay higher for longer, that, of course, puts pressure with tighter credit conditions, which flows through the economy as businesses, consumers find it more difficult to borrow. What are the likely effects then?
Yeah, well, we're seeing credit conditions globally again for both small and medium businesses, but also large companies, really at the highest level that they've been for quite some time. And I think if you go back in time, those credit conditions are as tight as they've been in 2008 and then the early 1990s recessions. Now, what does that mean in the real world? What does it mean for real borrowers? It means that if you're going to come through a period where you're invested in a company that has a refinancing coming up, that company's going to refinance on terms much tighter, much more difficult than they had previously. And that could actually result in a significant amount of the free cash flow they otherwise generate needing to be used to service debt. And that could see a significant slowdown in activity across the board. So look, I think that people do need to be cautious in that kind of environment. There's going to be winners and losers, of course, even in an environment of tighter credit conditions. And if we do see banks start to repivot their books, there are opportunities that emerge in that environment, but they are going to be more difficult and much tighter conditions going forward. I think for some time.
We just had that chart up, which was looking at those larger loans, but what you're saying, the same applies to smaller loans as well.
That's right. And look, for smaller companies, you can see it there. This is a graph that effectively shows how tight credit standards are. This is in the US. It was a barometer, I guess, of the global Western economy for small and medium firms. And you can see here how the levels that are there on that particular graph from the Fed are as tight as they've been for decades. And that really means that businesses are going to start to find it quite difficult to access finance, and that's the core finance they need for their operations. Now, a lot of what's happening in the US is driven by the dynamics of regional banks significantly pulling back because they've made a bad bet on both commercial real estate and they've made a bad interest rate bet. So there is a void there to step into and finance. Means it's more difficult on the equity side because if you own the equity of those companies, they're going to be paying more for their debt. If you can go in and lend into those verticals, then it's particularly attractive. You're in a defensive part of the capital structure. You can be in a senior or secured position, backed by assets and collateral. But the sort of returns you can command there, 8 to 10% plus, are pretty attractive at the moment.
How does an Australian investor do that? How do you get exposure?
Well, fortunately in Australia now there are a number of credit funds that investors can access that have a global remit. There are a number, we've got one, there's a number of managers that have them, whether they're in a listed form or an unlisted form, unlisted without volatility. That's one way to access that. You can go out there, of course, and try and buy either bonds or traded loans directly, but that's really hard because you've got to kind of do that bottom-up work. I think the main lesson for investors, if they're participating in that asset class, is think about the three most important things in credit, which is the defensive part of your portfolio and really should be giving you resilient income with capital preservation. And that means that the borrower needs to have really strong serviceability. So even in a difficult period of time, they can actually pay back their debt. If they can't, the second thing is make sure you've got really good collateral so you can actually protect your money if things do go wrong. And thirdly, you need to make sure you've got the right terms and protections in your loan so that if things do go wrong and you need to recover on your collateral, you actually can. And there's been a few Australian investors who've owned a couple of corporate loans lately who've really got themselves into a bind in that respect. And really what happened was they forgot the third thing in credit, which is they actually had a decent company that was the counterparty. Things did go bad, they had some collateral, but they weren't able to enforce on it, and now they're facing a difficult position. So you need to get the trifecta working together, and if you do, you're seeing the best returns in credit in a very, very long time. And I think that would protect your portfolio through a period of volatility that could continue for longer.
So Frank, I haven't spoken to you for a while, but just in terms of that typical structure of a 60-40 portfolio, is that working? Is that appropriate at the moment?
JP Morgan Asset Management put out a really good piece not long ago where they basically looked at, well, if you had a 60-40 portfolio and you compared that to a portfolio where you allocated 30% to alternatives, what happened? And essentially the outcome was that if you have alternatives in your portfolio in some sort of meaningful mix, you get higher returns with lower volatility. So your returns go up about 1%, but your volatility goes down about 20%. And that's really important because it's important for investor psychology. It's really hard to hold through periods of volatility, especially if you're a retail investor or a wholesale investor, an individual. And what alternatives give you is actually resilience through more volatile periods of time. The way I think about the 60-40 portfolio is a little bit different to that good work that JP Morgan did put out, actually, which is if you think about what's in it, 60% is equities of some kind. Now, traditionally, that's stocks. And 40% is credit, traditionally being bonds. I think that what you're seeing at the moment is that the best returns in both of those asset classes, the equity side and the credit side, are actually in private markets. But that means you have to trade off some element of liquidity. So I think what you really should be saying is how much of my equity should be in private equity, which now even retail investors and high net worth investors can actually get access to through a range of fund offerings. And similarly in credit, rather than just buying bonds, especially in Australia where bonds just mean, basically the big four banks' debt, if you can access a type of private credit, you can do it with a part of your portfolio where you're happy to have less liquidity. Maybe that's not now intraday liquidity, but it's monthly or quarterly or even yearly. And if you do that, you can actually obtain a higher return, protecting your portfolio and reducing your volatility. I think that's something that all investors really should be looking for.